Have you ever wondered how companies grow and how you can be a part of that growth? It's not just about taking out loans or getting venture capital. There's another powerful way, and it's something most Americans have at least heard of: stocks. Now, the word stock can sound intimidating, maybe even complicated, but the core idea is actually pretty simple. It's about owning a tiny piece of a company. Think of it like this. Imagine your friend starts a lemonade stand. To get things going, they need money for lemons, sugar, a table, and a sign. They could borrow the money, or they could ask a few friends to become partners, to buy a piece of the lemonade stand in exchange for some of the future profits. That, in a nutshell, is what a stock is. Instead of a lemonade stand, we're talking about much larger companies: Apple, Google, Amazon, Coca-Cola. These companies need money to expand, develop new products, or simply operate day to day. They raise that money by selling shares of ownership. Those shares are called stocks. When you buy a stock, you're buying a tiny fraction of that company. Why is this relevant for Americans? Well, for generations, owning stocks has been a key way for people to build wealth. It's a way to participate in the success of some of the most innovative and profitable businesses in the world. Historically, stocks have outperformed other investment options like bonds or savings accounts over the long term. It's not a get-rich-quick scheme, but it can be a powerful tool for financial growth. Let's look at a simple example. Let's say TechSpark, a fictional company, needs $1 million to launch a new app. Instead of borrowing all the money, they decide to sell 100,000 shares of stock for $10 each. If you buy 100 shares, you've invested $1,000 and now own 0.1% of TechSpark. So how do you actually make money from owning stock? There are two main ways. The first is through dividends. Some companies choose to share a portion of their profits with shareholders, people who own the stock. If TechSpark makes a profit and decides to pay a dividend of 50 cents per share, you would receive $50, $100 shares x 50 cents. The second way is through capital appreciation. This means the price of the stock goes up. If TechSpark's app becomes incredibly popular, more and more people might want to buy the stock. This increased demand drives up the price. Let's say the price of TechSpark stock rises from $10 to $20 per share. Your 100 shares are now worth $2,000. You've made a profit of $1,000. Now, it's important to understand that stock prices aren't always going up. They can fluctuate, sometimes wildly, based on a lot of factors: the company's performance, the overall economy, even world events. This means there's risk involved. You could lose money if the stock price goes down. That's why it's crucial to do your research and understand the companies you're investing in. So how do you actually buy stocks? Traditionally, you would use a broker, a professional who executes trades on your behalf. Today, however, there are many online brokerage platforms that allow you to buy and sell stocks directly from your computer or smartphone. These platforms often have lower fees and are more accessible to everyday investors. Some popular examples include Fidelity, Charles Schwab, and Robinhood. When you open an account with a brokerage, you'll fund it with money from your bank account. Then, you can search for the stock you want to buy and place an order. The order will be executed when a buyer and seller agree on a price. There are different types of stocks you can buy. Common stock gives you voting rights in the company, meaning you can participate in important decisions. Preferred stock typically doesn't come with voting rights, but it often pays a higher dividend. Another important concept is diversification. This means spreading your investments across different companies and industries. Don't put all your eggs in one basket. If one company does poorly, your entire portfolio won't be wiped out. You can diversify by buying stocks in different sectors: technology, healthcare, energy, consumer goods, and so on. You can also invest in mutual funds or exchange-traded funds, ETFs. These are essentially baskets of stocks that are managed by professional investors. They offer instant diversification and can be a good option for beginners. Let's quickly recap. Stocks represent ownership in a company. You can make money through dividends and capital appreciation. Stock prices fluctuate, so there's risk involved. Diversification is key to managing that risk. And online brokerage platforms make it easier than ever to start investing. Investing in stocks isn't about getting rich quick. It's about participating in the growth of the economy and building wealth over the long term. It requires research, patience, and a willingness to accept some risk. But for many Americans, it's a powerful tool for achieving their financial goals. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.